Okay, great. Thank you everyone for being here. It's my pleasure to introduce to you Vlad Cazacu. He's a co-founder at Flowly, an all-in-one fundraising platform that aims to help founders understand their runway, plan their capital needs, and explore financing opportunities. He has extensive experience not only as a founder, but as an investor, most recently working with Fuel Venture Capital in Miami. They're a VC firm that invests in seed to Series B technology companies, particularly B2B enterprise software. And previously, he worked as a principal at Assure Syndicates, a group of high net worth individuals and family offices focusing on early stage private equity deals, again, covering that span of pre-seed to Series B. While at Assure, he sourced and led investment in 11 companies and acted as an exclusive advisor to 5 private equity transactions using SPVs. And by the end of his tenure, he was managing 12% of an 8-figure AUM portfolio. And prior to this, he also worked with VU Venture Partners and FF Venture Capital. So really an extensive experience as an investor in the VC space. He's also a second-time founder and author of the book, When They Win, You Win, a more humane approach to supporting entrepreneurship. Vlad also holds a master's degree from the Macomb School of Business at the University of Texas at Austin, and holds 2 bachelor degrees from the University of Rochester. So Vlad, we're so excited to have you here, and thank you so much for coming to speak to our community. With that, the floor is yours, and thank you once again.
Thank you, Alex. My pleasure to be here. Appreciate the extensive intro. It kind of stole completely one of my slides in this presentation, which is like, why does this matter? But really excited to be here. We're going to be spending some time going over a few slides that I prepared for you, primarily around US fundraising, a little bit of like legal 101, and some understanding around the cap table dynamics and how you could be raising and certain decisions that you could be making as you're preparing for your next round, certain pitfalls not to fall into based on a few battle scars on both sides of the table. And then from there, we can go into a Q&A. Happy to answer any questions you may have. And we can take it from there. If you have any questions at any time, feel free to stop me. Just write it in the chat, or just feel free to unmute. I would much rather address it at that time than wait for it later. If you want to wait for it later, just make sure to write it down so you don't forget. I tend to forget all the questions I have during presentations. So with that being said, everybody can see my screen properly? Awesome. All right. So we're going to talk like US fundraising 101-ish. We can get into some more complicated topic depending on what you would like. As Alex was mentioning, I'm going to give a super quick background, and we're going to get into some understanding of US incorporation, LLC versus C Corp, and why investors may prefer one over the other. We're going to unpack a little bit the difference between SAFEs and different equities and convertible notes, and then dive deeper into, do I need a lead and how do I structure my round? How does a pre-seed versus seed versus Series A may look from the context of the things we just mentioned? How do I know which VC is right for me at what stage and what should I optimize for? We can, if you're interested, get into a little bit of the topic of who are you allowed to take money from if you're US incorporated and are interested in raising capital here, and talk just briefly about accredited investor status and what that matters to you, specifically what type of liability you're exposing yourself if you're not aware of the context of that one slide. And then we can discuss about individual angels versus syndicates if you believe that you will be taking money from individual angels at that time. But we'll get to that in just a second. Super quick on myself. I mean, Alex did an amazing presentation, but really brief, I was born and raised in Bucharest, Romania, then came to the States, worked at 4 venture firms, been part of about 100 transactions to date. So far, led 11 of those. Been an angel investor myself as well, about 40 companies across US and Europe, primarily pre-seed, seed, and Series A. And I currently co-manage a 40 million portfolio. That was the former Assure Syndicates portfolio we took private after our parent organization Cuenta. That's a whole different story for a whole nother day and many other beers. But we're now stuck with those investments. Just by quick show of hands, and I'm going to have to figure out how we can see everybody on this screen on this side. There you go. How many of you have previously raised institutional capital, like VC investors?
I hope everyone can raise their hand since you are part of our portfolio.
Okay, so institutional, everybody. All right. How about US-based institutional? And I actually think that OneTrip is US incorporated.
Correct. Yeah.
All right. So the answer to that will be everybody, hopefully. Okay. Then third question. Make sure you've done my research better on before jumping on this call. How many of you formed the US Delaware C Corp as part of your fundraise process, or are currently incorporated under a holding company, US Delaware C Corp? Okay, so some, but not everybody. Like the rest, I would assume Cayman Master Holding Co. Okay, and others. Is there an option C, not A or B?
In the chat, people are saying they're using the Cayman LLC sandwich.
Okay, got it. Okay, and some are US-based LLC or Cayman LLC. Okay, Delaware LLC. All right, awesome. A variety of different structures. So let's discuss super briefly on legal, which is the boring topic, but it's a topic that really matters. And 20 minutes on these slides can change your life, right? That's kind of the idea. LLCs versus C Corp and why that matters. Specifically for US-based, understand that investors prefer US C Corps over everything for several reasons. The primary one being the fact that you can delimit the risk between you, the investor, and the investment with this middle vehicle, which is the company itself. And on top of that, you get a separate entity tax treatment, which means that the company recognizes profits and taxes at their level, and then decides to send distributions or dividends over to their investors, compared to an LLC where all that profit then goes recognized on the books of the investor. Why that matters is because investors usually have portfolios of 20, 30, 40 different investments. And what they don't want to do is to recognize your net profit or net loss on their books at the end of every year and increase their tax bill for absolutely no reason outside of the fact that this wasn't structured as C Corp from day one. Cayman structures are a little bit different depending on where the investor is coming from. But again, if you are interested in raising primarily US capital, and we can go into a little bit detail afterwards why that might be the case, they may require you to form a master holding company, which is a US Delaware C Corp that then owns all the subsidiaries across all the jurisdictions where you do business. And the tax implication is primarily the number one reason why that's the case. Now, that there is a secondary reason why C Corps are preferred over LLCs, and that is the separation of equity classes. You've probably heard prior of preferred shared seed, preferred shared Series A, preferred shared Series B. Those are structures of equity that can only be created in a C corporation and not in an LLC. And these allow different investors to come on different terms and different preferences compared to other investors who came in earlier. Why that may be of interest, of course, a later stage investor outside of just price, right? The price they actually pay for your shares, may be interested in several clauses in that particular contract to protect their investment, because you are closer to a potential exit than an investor who came at seed may be. If you're an LLC, you simply cannot create that sandwich structure of multiple equity types. And then third, I would say, the easier to transfer ownership. An LLC is technically a partnership. It's really this like hybrid blend of a partnership and a corporation in the United States. So that means that everybody's really a member of that LLC compared to a shareholder. So in the case of a secondary transaction, LLCs are significantly harder to exchange hands than a C Corp. So for the people who answered LLC, US Delaware LLC, or just any US LLC, I would strongly consider thinking through the implications of that before your next raise rather than after, because during the raise itself, you may receive significant pushback from institutional investors in the United States because of the company structure. Cayman, a little bit different. You may get a little bit more leeway depending on how familiar those investors are with those structures. I'll say Florida, specifically Miami-based investors, very aware. New York and SF probably still very aware. Looking for an investor out of Texas or Chicago may not be as aware of the Cayman structure for you. And you probably, this is not of interest to you, but it may be of interest significantly to your investors. QSBS, that is an amazing clause in the United States that allows people to sell their equity in early stage companies without paying any taxes if they qualify when they made that purchase. You can only qualify if you're a C Corp, and that matters a lot to early stage investors. And for you, early stage may mean up to $50 million of enterprise value. So that could include even a Series A. Now, common shares versus preferred shares. This is a really interesting topic because I think a lot of people have not spent enough time understanding what they're really selling. Not all equity is created equal. When you're selling common shares, you're really selling shares that usually are held only by founders and employees. Obviously, they participate fully in ownership and in voting. They have no form of liquidation preference, so they just get paid pro rata depending on how much they own of the company. And again, they're a single class, so everybody is on the same rights. Investors can only acquire and will usually only acquire common shares in a secondary transaction. If you're looking what's happening right now with things like OpenAI, with Stripe, with the Ramp, so very late stage companies that are still private, they're not yet public, but people are interested in buying equity. They're not doing any new rounds, so people are saying, well, how can I acquire equity in those companies? Usually go to early employees, people who had options that then convert into shares and try to say, hey, Martin, I know you worked super early at Stripe. I'm curious to see if you'll be willing to sell me some of your common shares. And you're acquiring that because you're acquiring it from Martin. Now, in 99% of the cases, an investor comes in and requires preferred shares. And the reason behind that is because on top of participating fully in ownership and in voting, they may have additional rights and potentially even veto rights. Specifically, later stage, we see rights such as drag along, which means that if the later stage investors decide that it's the right time for you to sell the company, and a majority of the preferred shares decide that you should sell your company when you have an offer, the founder vote pretty much doesn't matter. This is important to you because you should pay very close attention to those contracts before you sign them and before you issue preferred shares. Make sure you understand not only the economic terms, which is the price per share, the valuation, all these other items, but also the control items. Are they joining the board or are they not? Do they have specific rights that may be irrelevant now, but may be very relevant later on? I can tell you from experience here, those things don't matter until they matter. And most founders, prefer, listen to the first part of that sentence and fail to project long enough in the future for the second part of the sentence to be true. And know that they can always be converted to common, the preferred shares. Now, there's a lot of ways the investors protect themselves against you converting them accidentally or willfully. But at the end of the day, they're just common shares with additional rights. Now, if you're not selling equity, and why you choose not to sell equity, because it's expensive, right? Issuing preferred shares requires a lawyer, requires you to create that series of stock in your company, requires for you to draft some pretty dense legal agreements that portray all these rights and everything that we just discussed. And you may say, hey, I really don't have time for that. I'm raising a smaller round, I'm raising a bridge, I'm raising an extension, I'm raising a pre-Series A or a Series A bridge afterwards, and I'm going to sell something else. The something else comes into flavors, safes, or convertible notes. They're technically flavors of each other, but it's with a very important distinctions. Safes, they're super simple to draft. It's in their name, a simple agreement for future equity, but they're neither debt nor equity. They're just a contract, which is really important for you to know. When you're issuing a safe, you're not giving away any equity, and you're not giving away a debt obligation to anybody else. You're simply drafting a contract. That contract doesn't have any ownership rights while outstanding, doesn't have any voting rights while outstanding. It's literally just a piece of paper that whenever you do your next round, that's going to convert into equity. Note that Now SAFEs come with an automatic conversion clause. In the past, they didn't. And the reason why they now come with an automatic conversion clause is because if you were to have sold your company in the past while SAFEs were outstanding, the investors were not investors in your company. So they would have received absolutely nothing for their investment. So investors learned their lesson and upgraded their documents. But note that this SAFE, it's a very interesting document to raise on. Obviously, it locks in a price or a percentage of ownership and does not accrue interest. In a convertible note, and I think a lot of founders, and I've seen a lot of Latin American founders default to convertible notes because they think are a little bit more attractive for US-based investors. I would say they're more attractive for any investor, and the reason why is because they accrue interest. So the longer they're outstanding, the more the investor actually owns of your company, which is really important for you to be aware of. Note that they are a debt instrument. So if you were thinking of not raising debt from, let's say, a bank or a lending facility because you don't want to have debt on your books, issuing a convertible note, it's adding debt to your books. That is the legal definition of a convertible debt instrument. So you have an obligation to pay that back, as opposed to a SAFE or issuing equity. If the company were to go bankrupt, you have absolutely no obligation to pay anyone back. Convertible note, as long as it hasn't converted into equity, still stays a debt. And depending on how you structure a company, you may or may not be personally liable for it. Obviously, investors are understanding of that, but never count on other people's niceness when money's at stake, because people do get a little bit weird when it comes to money and being owed money. So better to not owe anybody money. Really important on the interest, always check conversion terms and check your interest of convertible notes. I've seen at least twice a convertible note that was outstanding for 3 years. The founders forgot about it. The investors, I don't know if they forgot about it or they were just willing to let it go. But a convertible note accruing interest for 3 years may be selling significantly more of the company than what you originally planned for. And some of this you may already be aware, but again, it's really important to put on the map of your options. And the most important item to put on the map of your options is the waterfall concept. This is a concept a lot of investors are very familiar with. Some founders may not be as familiar with. That pretty much means in the case of a sale of a company that could be going bankrupt, a liquidation, M&A, or an IPO, how are people getting paid? In what order? And know that you who are owning common equity are the bottom of the waterfall. That means that if worst comes to worst and you have a lot of debt to banks, that's the senior debt, they'll get their money back. Subordinate or mezzanine debt, that's usually convertible notes or other form of not asset-backed loans, then they'll get their money, again, if they're not converted. Then it's the preferred equity. So all the investors who came in and had additional terms and additional clauses on top of that, they'll get their money back, depending on their liquidation preference, which, by the way, it's a very important term to know coming into your Series A, liquidation preference, if it's participating or not. We're not going to spend a lot of time on this, but there's a great book called Venture Deals by Brad Feld that goes into every single topic of the term sheet. I think should be mandatory reading for all founders. I see Alex nodding his head. It's a dense book, but a great book because it really goes over every single topic of this. And then it's common equity, which is you and your employees. Why does that matter? Because your incentive as a founder is to create a company so great that you get paid. I think a lot of founders who come into the VC journey, let's say when they're raising capital, are not really aware of the misalignment of incentives between them and the investors, because it's there. You're pretty much saying, I'm willing to sell parts of my equity to other people who will by definition be paid before I get paid. So I need to make a company that makes at least as much money as I got invested in me, and then ideally significantly more for me to participate in that upside. So the people who are raising a lot of money are always making a promise to themselves that are going to make a very large company, which sometimes doesn't work out. There was something in the chat. Okay.
Just reminding people to put their name on the startup name.
Awesome. I also do not speak Spanish. My girlfriend, we've been together for 3 years. She's Cuban. She's been trying to teach me Spanish, but I'm failing significantly at that task. So I'll stick to English tonight. Now, quick question for the audience, though. Where are safes on the waterfall? The simple agreement for future equity. Okay, someone must have an idea. Preferred. Okay. Any other answers? If not, we're going to go with preferred. Safes are not on the waterfall. It's really important. Let's go back. Safes are neither debt nor equity. They're just pieces of paper. If you were to sell your company before they get converted, they just don't exist. They don't get paid. They'll most likely convert into preferred if there is a preferred class available, but otherwise they'll just convert into common equity and they'll get paid last with you. So know that safe investors, primarily angel investors, are taking a significant risk and a significant bet on you. Treat them nicely, convert those safes into equity whenever you're available. Don't leave those hanging for too long because it makes everybody anxious. Now, do I need a lead and how should I structure my round? If you're raising a pre-seed, a lead is most likely not necessary. You're probably going to do it on a safe. The expectation of that is that soon enough, you're going to create a preferred round for those people to start converting. Sometimes that happens at seed, where lead is a nice to have, especially if you're raising more than $1 million, a more substantial seed like $1 million, $2 million, or $3 million. And you may do it on a safe or a convertible note, but there may be some investors, especially if you have a lead, who are going to push to make it a price round. In that case, just make sure that the lead is serious. Just make sure that they're truly committed to leading this round before you begin entertaining conversation with a lawyer. Lawyers get very expensive very fast. So don't think about creating a preferred share class just in preparation for your Series A. That's never a good practice. There's some things that are just part of the process and people are expecting that to happen. And some term sheets may have some coverage of legal fees that are split between the investor and the founder. In some cases, the investor may cover all of it. There's a few really nice and good people out there. If you find them, cherish them and allow them to pay your legal fees. But in most cases, are going to be split, or the founder is going to take full responsibility for those price rounds. Now, in a Series A scenario, a lead is required because you must have a term sheet to raise a Series A. Now, is it required by law? No, of course not. But again, it's required for you to be able to raise a Series A of anywhere from $4 to $10 million. No institutional VC is going to follow a Series A that doesn't have an institutional lead to put the terms, because everybody's expecting someone to set the price. And as I mentioned, set the price, that means that by definition, there's going to be a price round, there's going to be a term sheet, and you're going to be able to negotiate all these details of economic terms and control terms with the lead. The lead may join the board of directors. You may be willing to give such a seat. And in some cases, a co-lead may join either the board or the board observer. I don't have a slide on that, but really important, the difference between a board director and a board observer is that one is voting and actually has control and the other one is not. Now, don't get too many board observers because they can still speak in meetings. It's their right. And that matters. The more people you have in a room, the longer those board meetings are. And I've definitely been in board meetings that ran, 6 to 8 hours. Sometimes because there were too many people in the room who felt the need to say something. Now, you may say, well, that doesn't matter because the only board directors vote. That's true. But again, be mindful of your time. Make the board a nice experience for everybody. Try to do it in person if you can, and really make the most out of that time for people to know how they can help your company, what you're struggling with, and what the next step is, and allow them to partake in the strategic conversations that are taking in your company once a quarter. The board observers are there primarily because an investor has a significant stake in your company, but not significant enough to warrant a director vote. However, they want direct access to not only the financial statements and all the, let's say monthly or quarterly updates, but also the forward-facing conversation of you and how are we thinking about the next quarters and the company. Something you would say? Great question. So you most likely have a board already if you're a US Delaware C Corp, because you're legally required to have a board. Now, most of the time, the founders are on the board. Sometimes all the founders, sometimes just the CEO, and it's a board of one. I highly suggest if you have co-founders, everybody should be on the board, because if you're granting someone the title of co-founder, you've already, let's say, married yourself with that person in a way. So you must make sure that not only the operational incentives are aligned of like the day-to-day and their role, but also the larger vision of the company is aligned and they have a vote in that. Now, you may have situations in which at the seed round, one of the seed investors, if there is a price round, and that's a big if, you won't really see any board joining because they own a safe, because again, they don't really own anything. In a convertible note, it's like asking your banker to join the board of directors. You probably won't, just because you owe them money or you have a credit card with Chase. But if it's a price round and they decide to join the board, or they want to join the board at the seed round, think of, I would say, two items. One of them is the individual, and do you see them being on the board for the next 3 to 4 rounds? Do they have ability to come with the Series A, or are they primarily a seed investor and that's it? They don't follow on. So their financial implication, in the company, it's only at the seed board. The board of directors is a very forward-facing group of people. So think of the people who can make a mark over your next milestones. And from an investor perspective, it almost always means they can participate in your next round. Because if they cannot, they shouldn't really be at the table of people deciding, are you raising that? And if you are, on what terms? And are we accepting this term sheet or not? Because they don't have any financial implication that whatsoever. So that's one. And the second piece is regarding their ability to be a great board member. Now, this is not something that you can uncover early on. And unfortunately, founders just don't get enough, reps on that, because you most likely will fund 1, maybe 2 companies, 3 companies throughout your lifetime. So you may have at most 3 boards, whereas an investor by default is probably going to be on like 10 boards in their first 2-3 years in VC. So they just have more reps to understand how that works. There are people who can provide true value and can challenge you respectfully and can understand that they're there to help you make better decisions. And they're like a great second in charge, like a right man, right? Like a great right man. And there's certain people who want to be the leader and who are seeing the board as an opportunity for them to, quote unquote, exercise their control over the company. Try to get the former, try to stay away from the latter. And again, it's very hard to get this from the very first conversations. Err on the side of caution, and err on the side of, if you're at seed, say, hey, look, like we may not extend the board right now, but I'm open to give you a board observer seat. You're not going to have any voting rights. We're going to test drive it for 6 months. And if we realize it's a mutual relationship that we both benefit from, let's make it official. In 6 months, you become a voting board director. And if their answer is like, no, fuck that, that's an answer by itself, right? Like, why on earth would they argue against that? Which, great question, and brings me to my next slide. How do I know which VC is right for me? And obviously some of this, there's a thing in the chat. Thanks. Of course, more than happy to. Obviously part of it is, very obvious, right? You must align yourself with the thesis around industry, stage, business model, and geography. Always check those before reaching out to investors, specifically at Series A. I cannot tell you the amount of deal flow that was just completely off thesis that we got at any of the firms I work with. And, I want to be blunt on this. Like, it's not our fault. It's like the founder's fault, right? It takes literally 30 seconds to review a website and make sure that you're aligned with their thesis. If they invest in Europe and you're based in Ecuador, don't reach out. Like, there's just nothing that can really come out of it until you're pretty much saying, oh, I know you know someone who invests in Latin America, therefore I'm just reaching out to see if you can make an introduction, for example. But the more important piece outside of just the investment thesis is the expertise and value add. And I just gave you like 5 vectors to think about expertise and value add, because it's a very like, abstract topic to discuss, like what is really value add. I think even investors are struggling to put that in words. Think of industry and business model expertise first, because if you don't have people who understand what you're doing and have not backed any companies in that type of industry or following that business model that have minimal impact on the strategic vision of your company, and that's going to hurt you in the long term, specifically it's from a lead investor, because people are not going to perceive them as serious signals for the next round. If your Series A is a direct to consumer expert in their space, and you are a B2B fintech company, no follow investor is going to really take the fact that they're leading you around as a great signal. Could actually be a very negative signal for you. Second, network of other investors. This is incredibly important the later stage you are. Come seed, important. Come Series A, super important. You are most likely not going to raise your Series A alone. That means you're going to optimize for a leading investor who has a great network of investors, and they're going to help put together a syndicate of other people they work with, because they know their strengths, they know their weaknesses, if they're honest to themselves and to you, and they're going to figure out what group of investors is right for you. Obviously, you're going to do your outreach as well outside of just the lead, but the lead is going to play a critical role in that journey. Third, network of clients. The number one value add that an investor can give to their founders is a customer. Revenue matters more than anything else. It's better than a dollar invested, because a dollar invested is a dollar invested on your cap table, which they took a piece of your company. A client is revenue, top line on your income statement, doesn't follow through to equity whatsoever. And there are investors who are optimizing for this during the due diligence process. And specifically at the Series A, especially if you're B2B, which my understanding is that you're primarily B2B in this cohort, they should be able to make some high-level introductions for you. If they're not, they're potentially not a great Series A lead investor for you. Fourth, network of talent. And I put them in not necessarily in order outside of one, which is number one, the most important. At Series A or after Series A, you're going to start hiring potentially a lot of middle management. You're going to start thinking a lot of your VP of engineering, VP of sales, potentially even a VP of talent, VP of customer success. You're potentially going to bring on a CFO if you don't have one already. You're going to start thinking about creating that management class in your company. And investors have a great roster of other founding team members or other executives they previously worked with that can help fill in those roles. Now, that doesn't mean treat investors as a recruiting agency, because they're not. But a great Series A investor will at least be able to point you towards some potential hires that you may have for some of those key roles. And last but not least, and something that I was mentioning earlier on the board, ethics and personality. I think there's there you go. Ethics and personality. Know who you're making this contract with, and spend enough time doing that due diligence. As a founder, you're the one at the end of the day who's deciding who's becoming part owner in your company. Make that decision in full awareness of the implications of that, and make sure that you partner with the right individuals. I also host a podcast called Fundraising Debrief, and I'm not trying to plug it in, but there's a few episodes that are like really great because of the guest, not because of me. I just asked the question. Specifically, episode 3 with Lamin Zarad. He's the co-founder of Stellify, third company. You can find it on Apple Podcasts or Spotify. We're just debriefing rounds that have just happened with the founders who raised them. And we go a lot into the topic of what makes a great partner from an investor. And I've used in the interview the expression of, getting married, right? A lot of people in the industry say, think of it as like marriage, right? Because you're pretty much with that investor for 10 years or more. I hope marriages last longer than 10 years, but regardless, it's a somewhat okay metaphor. And he said that's bullshit. And the reason why that's bullshit is because in a family, you let a lot of people just, be, right? Your cousin didn't do the dishes last night, or your kid didn't take the trash out when it was their duty to take the trash out. It's okay. And you give them slack. Whereas in a relationship with an investor, it's more like going to war. He's also an ex-Navy SEAL, so maybe that's why he was his, metaphor. And if you were thinking of, going to war, you would probably think of your generals and your soldiers and your battalions and people who are like really aligned with that, mission, and make sure that they have your back, because, the worst outcome of that is death. And in this case, the death of the company. So he's pretty much saying, like, think of the investor-founder relationship as probably one of the, has to be most aligned relation that you'll ever have in your life. Because if you're not fighting in the same direction, the company is going to slowly start ripping itself apart. And unfortunately, history is full of a lot of examples of that. I will pause the presentation here because we're, I think right about half an hour in. And the rest of stuff is like somewhat related to your stage. I'll have the PDF. I'll share that with Alex so you can review that afterwards. But I'm here to answer any questions. If any of this didn't make any sense, it's okay. Some of these are more complicated legal and financial topics. And it's my email. I do answer all my emails in 24 hours or less. So feel free to bombard me with that. It's what I do every single day. And that's about it from the presentation. Happy to join in the Q&A. And if we have more time later, we can discuss that afterwards. Thank you, Alex, for putting the link on the episode. Is that the link with Lamin?
Yep. Yeah.
Nice.
That's your LinkedIn.
Awesome.
Post. So yeah, that was great. Thank you so much for that. So we open up to questions. I don't know if anyone would like to comment. Anything that you guys want to discuss? Any questions? People are a bit stumped. Yeah, I guess I have one question that maybe you can help us untangle. So when you're thinking about valuations, I guess in the very early stages, and when you're walking up to a price round, could you like maybe isolate one or two factors that are gonna help you kind of frame your thinking around the value of your company? And you mentioned as well, common stock, the fact that you as a founder, that's where you get paid basically. So how do you think about that? How do you think about the valuation of your company between those two stages?
That's a great question, and I would say I'll start with like a piece of I wouldn't say advice, just like like what's the anti-advice? Like don't do that. I don't know. Whatever. A warning: don't be greedy on valuation early on safes and convertible notes before you have your first price round. And the reason why that's the case is because the price round is most likely the first time when you're going to have a very honest and data-driven and ideally financial-driven decision on how much your company is worth. Now, it's not going to be a classic private equity, multiple on future cash flows, because who knows when you're really going to have, positive cash flows. But is going to be most likely a combination of a multiple on revenue with some adjustments made for revenue growth and user growth, right? If your company is truly growing greatly month over month, you may afford, or at least the investor may afford, a larger price, right? A larger multiple on your revenue because the velocity is there. There may be some other usage metric if you're primarily B2C that, if you're blowing that off the water, again, there may be some slack on the multiple because, again, you can afford it. Now, if you're B2B, that's probably the velocity of sales, the velocity of the sales cycle and how fast you move from a lead to a contract and implementation. That's probably going to be your biggest driver of, multiple adjustment, let's say. If you are very slow in your sales, you're probably going to tend closer to like a 10, 12x on your top line, potentially baking in some contracted revenue kind of all together because it's going to convert into revenue at some point. If you're seeing some really fast implementation, great usage, etc., you may be going to that 15 to 20x on revenue at the Series A. But if you're aiming for something like 40 or a 50, you're making a very large growth bet. And only make that if you can kind of hold your pants, right? I don't know what's the expression in Spanish, but like don't make promises you cannot deliver on. Actually, I don't even think that's an English expression. That's 100% Romanian expression that I've just translated into English. But safes and convertible notes have a price depending on what people are saying. Oh, safes don't have a price. They do, because they do have valuation cap. That's really a price in a way. It's not a price per share, but it's an implied price of your company. And if you've issued significant safes at 20, 30, 40, $50 million post money cap, and you're coming with a price round that is at 20 million. Why? Because that's what the metrics are saying. All your previous investors are going to be pretty pissed off. And the reason why that's not nice is because they may be a substantial part of your Series A because they want to double down their pro rata, etc. And they may decide not to, because all the risk that they took early on was pretty much worthless because now you're giving the same price to the Series A. Or the opposite, they may say, we're not letting you do that. And we're going to do everything that we can to make sure that you try to get as high valuation as possible with the Series A. And if the market says, I'm sorry, we can't offer you that, you're kind of stuck into a situation where you may run out of money because you cannot find a great deal on the table for you to raise. So the way I would think of pre-Series A valuation is try to follow the market and adjust by your growth, but don't adjust too much by your growth, because you may have 20, 30% month-over-month growth for 3, 4, 5, 6 months. And I really hope you do and keep that for the next 5 years. But the reality is that some of those hockey sticks are not truly hockey sticks, are a small hockey stick and a small plateau and a hockey stick and a small plateau. And you don't really know how long that plateau is. And try not to be in a crunch for money when the plateau hits, because that's not a great position to be in. So grow into your valuation, be mindful of the price you set on your safe and convertible notes. And you can quote me on that. I said that on record. There is a price on safe and convertible notes. And don't be too greedy early on, but be greedy on your Series A. Negotiate that thoroughly, because the Series A investors are going to be the first true institutional VC who's going to push back the most on valuation. But they also, in theory, should have the best financial model to back it up. So make sure you've caught up on your accounting and finance if you're not an accounting or financial person coming into your startup, or you don't have one. And definitely befriend a part-time CFO or a fractional CFO. I would say a few months before your Series A. Like get your books in properly done, and get a good financial model of where you at and where you could be going over the next 2 years before your Series A, because you're going to be competing against an analyst or an associate who spent the past 5 years creating ridiculous financial models, and don't allow them to beat you. I guess that's the advice. Come prepared.
Jacobo, go ahead, please.
Okay.
Thank you, Alex. I don't know if you can listen to me well.
Yep.
Yes, thank you very much. Hi, Vlad. Thank you for all your knowledge. I would like to know, we are facing a very particular moment where we have been raising some capital, and it has been easier than I thought, to be honest.
Yep.
But not too easy neither. But now we are facing that moment where we feel that we have diluted too much. And maybe the main reason why we feel that is because we entered in 500 startups. And that was the second, accelerator fund that we applied to. So that led us to dilute a lot, because those kind of funds take a good bunch of valuation, So now, with the last round, not round, but the last raising and the last tickets that we have raised, we are between 30% of dilution. So we have 70% and 30% is practically for all the angel investors and the funds that we have already raised. So now we're considering to do not have a seed round, because we're supposed to have only the pre-seed round, and we're thinking about not having a seed and going directly to the Series A. But we are in that moment where we are trying to estimate if with the money that we have already raised, we can have enough runway to go ahead and to have enough fuel to go to the next step. So I have two questions for you. What do you think about having that 30% of diluted, in the stage where we are now, considering that we have almost 1 year, 12 months of runway. And even when we are growing very fast and we have great traction metrics, we are afraid about if we will, where is the sweet spot when you have to raise more money, or it's better to, because now we're in that moment when we have several funds that want to invest more. And we are in that moment when we are considering to say those funds no, we don't want more money now, because we are, we have enough dilution. But we feel that we are, leaving money on the table. So it's very anxious for us. We are getting very anxious about that, because rejecting funds, especially two funds that are very interested in investing in us, I don't know if it's the most stupid thing to do now to reject money, considering the situation. But we are very diluted, and it's hard for us to raise the valuation with these two new funds that want to invest. Yeah. What are your thoughts? Sorry, because I think that I don't know if I have the right way of expressing our problem.
You did great. I appreciate you providing the context, because I think the context is needed to be able to actually provide any meaningful answer to this question. And I appreciate you bringing it up. I think it's a great topic to discuss. I think a lot of other people may get some value out of this conversation. Now, let me address the questions in order, right? Like, is 30%, let's say, post pre-seed as a round, pre-seed as pre-comma seed as seed being the round, is that too much? The honest answer is yes, right? So like that's a lot. And I understand that you may have done that through accelerators and some additional funds, and you may have done it probably staged over a period of time and got some angels early or some people early at a better valuation. So as a result, they got a larger part of the company. Regardless of how you got here, I would take a step back and ask myself, with the runway that we have, how much revenue growth can we really achieve? Because my gut reaction to what you said would be, the time spent being on this webinar should have probably been spent acquiring 2 or 3 more clients. Because right now you've sold enough of your company that your number one priority should be putting this product in front of as many people as possible and generating as much revenue as humanly possible, in order to increase that runway, ideally to infinity, because you reach profitability in the next year. And if that sounds impossible, it means that like there's a 1% chance to do it. And like, if you're a great founder, you'll be able to achieve that. And if you're an okay founder, you maybe get close to that. And if you're not a great founder, you won't achieve that, and the company's going out of business. And that's just how the world works, right? But I think having that honesty with yourself and saying, okay, now that that piece of the company sold, how can I get as fast as possible to the revenue target that I need to ensure that I'm, Paul Graham uses the term default alive, right? Like you can sustain yourself indefinitely with the revenue that you're generating and your revenue growth. And if I need to raise more capital, I'm going to come it from a position where if someone is to put a 15x multiple on my top line revenue at the Series A, I won't take that much dilution as I need. Now, I'm going to give a counter argument to the argument that I just made, which is you may be willing to go for more than 30%, but you may only be willing to do so if the additional capital is unlocking some form of insane growth opportunity that otherwise is cost prohibitive to approach. And it's a big bet. It's a bet that I would sleep on for a few nights before making that call if I were the founder of that company. And I would say, should I sell a little bit more because adding another $1 million to our cash reserve allows us to spend probably half of that on this highly aggressive growth tactic, and we're going to like quadruple or quintuple our revenue over the next 12 months, and it won't matter because the pie is now so much larger. If that option is not there, because sometimes it's not, like sometimes we don't have that amazing distribution channel just available for us, and it's okay. Focus on the things that are working, optimize your conversion cycles, optimize your upgrades to pro or whatever thing that you're selling if you do have a free version, and make sure that your business is as bulletproof as possible before adding another single dollar in your cap table. And I gave this advice a few times on some early stage founders, which is capital is an accelerator, but it's not setting the direction of your company. So if you were to think of like a vector, right, in like a three-dimensional space that has some form of direction, is going from the point zero to some form of coordinate, you're deciding the coordinate. The capital you're raising just decides the velocity. So if people are raising a lot of money at safe before they could figure out their coordinates and their vector is like heading down because they're going to go bankrupt, the unit economics don't make sense, the CAC is out of control, the LTV is not there, the churn is out of the park, there's no retention whatsoever, more capital is only going to make more of that happen faster. They're not going to go bankrupt, they're actually going to go bankrupt faster because they're in the wrong direction. So at every stage of your company journey, you have to be really attentive on how you set that direction and make sure that is set before you raise that capital for that round. Because once the money is in the bank, you may say, I just covered my ass for like 3 years. I have a lot of runway. I won't go bankrupt, which is great. Sometimes the cushion is amazing. Or you may say, I've raised this money because I know exactly where I'm going and how I'm spending this makes a lot of sense because in 12 months from now, I'll be able to be in a different position and raise the next round at the price that I need to not get overly diluted. But if you don't think 2 rounds in advance, then taking the money now, also I have no clue what those balloons are. It's a new AI from Zoom. But if I got distracted by the fucking balloons. If you're not thinking about the next round in the current round, you're missing the target that you must reach with the money that you're raising right now.
But how do you define that target? It's exactly what you say is what I am trying to figure it out, because I feel that we must define where is that target, but we don't know how to define that. How do you define that target or that line in the sand? Where you say, okay, this is the point where we have to reach in order to take the brave decision to go further, and where's that line, or how do you define that?
That's a great question, and sometimes the answer is not like obvious because it is personalized to some extent to your company. But I would take as a light pole, and I'm going to be like very rangy here, if that even is an adjective in English language. I would aim for, let's say, 15x on top line revenue at Series A, and to not sell more than, let's say, 12.5 to 20% of your company at Series A. So if you do the reverse math and say, what would it take to sell about 20% of my company at Series A because of how much money I need at that stage, and that valuation can at most be 15 times how much money I'm making at that time, you can sort of reverse engineer revenue target for that Series A to start making sense. At Series B, you're probably looking at selling 10 to 15% of your company, right? Potentially also in that 10 to 15x top line revenue. So now again, you can go back to the drawing board and reverse engineer what your revenue has to be there. And I can put together, over the next few days, maybe like a super quick Google Sheets model that maybe gives you a somewhat arbitrary number. But the important thing is, that you are on a path to $1 billion in valuation, which traditionally is $100 million of ARR. and you know as the CEO how much money it will actually take to get there, or at least you have an idea, or at least you should have an idea, right? Because you may have certain bets you want to do on sales and marketing to get there. And you may also have an idea of how likely you are to achieve from where you are right now to $100 million in revenue over the next number of years in 12 months increments. Pretend you're raising around every 12 months for some additional capital to put, fuel on the fire, but make sure that you're raising that capital, because in 12 months, you should be in a completely different spot than where you are right now, right? So all the phrase that VC use, like triple, double, right? Like the idea over the first, after you raise the first amount of capital, ideally your pre-seed, they're going to triple first year, triple second year, double the third, double the fourth. Now, it's aggressive. Some companies perform better, some companies don't, and there's not a problem. Some people are later bloomers, and some of those build stronger companies as a result of that. But if you're not able to double your revenue, especially or triple in early on, then you either don't have the right strategy or you have not raised enough money right now to be able to do that in 12 months. Does that give you any light posts in the question that you asked?
Thank you, Vlad. Yeah, that was
absolutely
amazing. I'm mindful of the time. We are meeting for 1 hour, so we're right on the time. So I don't know if anyone else has any last minute questions. Martin,
only a favor. Could you please share with us that spreadsheet with that numbers that you just said?
Sure. I can put one together and send it over. I'll put it on.
Please, it will be great for us. Sorry, Martin. Dale, Martin.
Thank you, and thanks, Vlad. Just following up with Jacobo's question, we're approaching our Series A, and we're thinking a lot about dilution and what's the ideal dilution before the Series A. When talking to US-based VCs or Latam-based VCs, when they are looking for startups and you're raising a Series A, what's the expected dilution by that time to be?
10 to 15% per round. So if you raise the pre-seed and a seed, 10 to 15% twice. If you only raise one round, 10 to 15%. If you also went for an accelerator, right, you can make an adjustment for 5 to 7 or 8%, depending on how much they took in lieu of a pre-seed or in addition to a pre-seed. But anything more than that, it's going to put you towards the upper boundary. So in the case of Jay, around 30%, that's probably towards the upper boundary of pre-Series A raise. And that's why you either make a really bold bet of increasing revenue to justify a very large valuation, or you protect your dilution until you're able to justify whatever you need for a Series A.
All right, thank you. Yeah, we have a 37% dilution, but we went through 2 accelerators.
Yeah.
And it was between 10 and 15% per round. We had 2 rounds before a pre-seed and seed, and now we're going to a Series A.
Yeah. Is your revenue above, let's say, the average Series A?
I don't know. What's the
I would say right now, probably looking at 1.5 million in ARR.
Yeah. 1.5 million in ARR?
Yeah.
1.5.
Yeah, we're looking this year at 1.6, and next year around 2.2.
Okay. Yeah. So again, you're just around there, right? So you're going to be necessarily bucketed in it's appropriate to raise a Series A, but they've done some over dilution in the beginning. That doesn't. You're not at a point where that becomes a point of concern in due diligence. So there's no point of concern of someone owns too much of your company, that they may be detrimental to your growth, or they may have too much control. You're not there. Those are companies who have 60%, 70% dilution, and trust me, it happens, and it's really sad for the founder when it does. However, you may make the choice of saying, I may raise a smaller Series A to protect myself, or again, similar to Jay, if I do decide to raise a more, what is traditional, right? There's no cookie cutter approach, but a more traditional Series A where I'm giving, let's say, 15% or up to 20% in my round, because the lead requires that ownership, I may as well go for a larger capital raise, have as large of a Series A as possible that protects that dilution, and make use of that money, because by the Series B, the company is going to be in a significantly better spot. And I may not need to raise, if you're planning to raise, let's say 2 rounds after your Series A, you may say I should only raise 1 because the revenue growth was there. So again, in spots of 30 to 40%, you either go for it or you play it safe, but there's no middle ground,
Yeah, that was my next question, is about, there's this new pre-Series A round, which I don't know if it's like this middle ground that will lead to too much dilution before a Series A.
The middle ground is going to most likely take you to a 40, a 45, and then we're going to meet a year from now and we're going to be having the same conversation for a sort of a bridge, because now we're above a Series A but not really at a Series B, so we're somewhere in between.
All right.
Yeah, that's my honest opinion, right? So I'm going to be as direct as I can.
Thanks, Vlad. Yeah, it was clear enough.
Yeah.
Thank
you very
then.
much.
Of course.
Okay, so I think we are basically out of time, but Vlad, I really appreciate your insights. Super interesting to hear your analysis coming from more advanced rounds, and how our founders specifically should be thinking about how this affects their companies, but also themselves as founders. So we really appreciate the time you have with us. And I don't know if you just want to mention a bit about where anyone can find you. You mentioned a podcast. We shared the link in the chat. Perfect. But if you want to plug anything else, go ahead.
Sure thing. It was really my pleasure, and I mean it when I said that my email is there, vlad@flori.com, spelled with an L-I-E because L-Y was taken. And happy to answer any emails that come on anything. And I'll prepare that spreadsheet and send it over to Alex. I mean, just a good thing, and maybe other founders may find value out of it. So other founders may thank you for asking me to do this now. And in the meantime, we do have a podcast that's the Fundraising Debrief, which may be most relevant to you. It comes out every other Wednesday. There's a new episode coming tomorrow. We do have a lot of Series A planned. I think we only have 1 Series A that went out, which was the podcast that I mentioned, the episode that I mentioned earlier. We have some pre-seed and seed. We have a Reg CF coming tomorrow, which may be really interesting if you're interested in that topic. Someone who raised, I think it was $6 million in Reg CF, and we're unpacking that. Just something good to listen in the morning when you're drinking your coffee. Outside of that, if you're interested in Flowly as a platform, we're not a broker dealer, so we're not doing any raises for you. However, we're only one fundraising hub, and we do have secure document sharing. So if you're familiar with DocSend for secure deck sharing, that's one of our features. Obviously, we have many more of that. It's free to start, flowly.com. And the only asset I would have for you is that if you decide to give us a try for your Series A in preparation to help you guide through that process and share documents with their access tracking and all that stuff, let me know what you think. Give me some feedback. And at this stage, it's super important. It's a recent project. We jumped ship from the investor role 5 months ago, so we're really in that pre-seed stage with this company. Second time around, it's very exciting. But right now, we're optimizing for feedback. And if it's compelling enough to buy the pro version, please do so. We won't say no to revenue, but no expectation there whatsoever. Outside of that, generally really appreciated this. And if I can be of value in any other way, let me know. If you're looking for introductions to your Series A in the United States, for that, I will require you to send me your flow link, because I'm going to put that flow link into my system and see through my network if anybody is interested. But outside of that, more than happy to make introductions for you after reviewing the company materials. Still very plugged in at that stage.
Awesome. Well, thank you so much. This has been a great talk. People were already asking for the presentation and the tool in the chat, so we'll get that to you guys as soon as possible. And with that, thank you, everybody. Have a good night, and thank you most of all, Vlad.
Awesome, yo. Cheers.
Bye. Ciao, ciao, everyone.
Thank you. Bye.